Welcome. Today we are going to explore something that might change the way you look at the markets. We are diving into the world of the simple moving average. The simple moving average is a tool that traders have used for years, and by the time we are done here, you will know exactly why. We will cover what the simple moving average is, how it works, and how you can start using it to understand market trends. So stick around, because by the end of this, you will feel more confident and informed in your trading decisions. Are you ready to learn? Let us get started. Let me ask you something. Have you ever felt overwhelmed by the constant price changes on a stock chart? Prices seem to jump up and down with no clear direction, right? This is where the simple moving average comes in. It is a tool that can help you see through the noise and understand the bigger picture. First, let us answer the basic question. What is a simple moving average? The simple moving average, or as we will call it from here on, the moving average, is a way to look at the average price of something over a certain amount of time. Let us break that down in an easy way. Imagine you are interested in the average price of a stock over 10 days. You would take the price from each of those 10 days, add them all together, and then divide by 10. That number is your average. The moving average does this calculation automatically for you on a chart, and as each day passes, it removes the oldest day and adds the new one. This is why we call it a moving average. Now, let us take a deeper dive into chart patterns that can help you identify trends and make better trading decisions. Recognizing these patterns along with using the moving average can improve your ability to predict potential market movements. Some of the most common chart patterns include head and shoulders, double tops and bottoms, triangles, and flags. Each of these patterns can signal a potential trend, reversal, or continuation, and knowing how to identify them is essential for any trader. The head and shoulders pattern is one of the most reliable indicators of a trend reversal. This pattern consists of three peaks: a higher peak, the head, between two lower peaks, the shoulders. When you see a head and shoulders pattern forming at the top of an uptrend, it often indicates that the market is about to turn down. Conversely, an inverse head and shoulders pattern at the bottom of a downtrend can signal that the market is ready to move up. Another pattern to watch for is the double top or double bottom. A double top occurs when the price reaches a high level twice but fails to break through, indicating that the uptrend may be coming to an end. A double bottom, on the other hand, forms when the price hits a low level twice and cannot go lower, which can indicate the start of an uptrend. These patterns are often easier to spot when using moving averages to smooth out the price data. Triangles are another important chart pattern. There are three types: ascending, descending, and symmetrical. An ascending triangle has a flat top and a rising bottom, suggesting that the price is likely to break out upward. A descending triangle has a flat bottom and a declining top, indicating a potential downward breakout. A symmetrical triangle forms when both the top and bottom converge, which can signal a breakout in either direction. Moving averages can help confirm these breakouts by showing where the trend is likely to continue. Flags are continuation patterns that indicate a brief pause in a strong trend before it continues. Flags form after a significant price movement, and they typically slope in the opposite direction of the prevailing trend. For example, in an uptrend, the flag may slope down slightly, and in a downtrend, the flag may slope up. When you see a flag forming, it can be a good time to prepare for the trend to continue once the flag breaks. By combining these chart patterns with moving averages, you can strengthen your analysis and trading strategy. For example, if you see a double bottom forming along with the price crossing above a long-term moving average, it can give you a stronger confirmation that an uptrend is beginning. Similarly, using moving averages to confirm a breakout from a triangle pattern can add confidence to your decision to enter a trade. Learning to recognize these chart patterns takes practice, but once you become familiar with them, they can be powerful tools in your trading arsenal. The key is to combine these patterns with other indicators like moving averages, relative strength index, and volume to get a more complete picture of the market. Why is this moving average useful? The moving average helps us see the general direction of a market without getting overwhelmed by the small ups and downs that happen each day. If you are staring at a chart, you might notice prices going up and down all the time. The moving average helps smooth those movements out, giving you a clearer picture of the overall trend. This way, you can see if a market is generally moving up, down, or staying steady. Now let us talk about the different kinds of moving averages and why you might use one over another. You can use different time frames for your moving averages, and each time frame has its own unique benefit. If you use a short moving average, like 10 days or 20 days, it is going to follow the price very closely. This means it can be useful if you are trying to catch short-term trends or make quick decisions. But because it follows so closely, it can also give you signals that might not always be very strong. If you want a balance between short-term and long-term trends, you can use a moving average over 50 days. The 50-day moving average does not react as quickly as the 10-day or 20-day moving average, but it still gives you a good sense of what is going on without every small movement affecting it too much. For those who are interested in the long term, there is the 200-day moving average. This is the type of moving average that investors use to understand the big picture. The 200-day moving average moves slowly, and because of that, it can give a good idea of the overall trend in the market. This makes it useful if you are looking to hold a position for a long time. So now we know what the moving average is and how different time frames can help. Let us talk about how to read a moving average. One of the simplest ways to use a moving average is by looking at where the price is in relation to it. If the price is above the moving average, this is generally seen as a good sign. It shows that the market is strong, and traders might consider holding their position or even buying more. But if the price is below the moving average, it might signal that the market is weak. This could mean it is time to sell or to stay away from buying. In addition to understanding the relationship between price and moving averages, recognizing certain chart patterns alongside moving averages can provide deeper insights into market behavior. For example, let us consider trend lines and channels. A trend line is a straight line that connects the lows in an uptrend or the highs in a downtrend, showing the general direction of the trend. When combined with a moving average, trend lines can confirm the strength of a trend or help identify potential reversals. If the price breaks below an uptrend line and moves below a moving average, it could indicate the beginning of a downtrend. Another key chart pattern to consider is the wedge pattern. Wedge patterns come in two forms: rising wedges and falling wedges. A rising wedge is generally a bearish pattern that forms when the price makes higher highs and higher lows, but the range gets narrower over time. If a rising wedge forms during an uptrend and the price falls below the support line of the wedge, it can signal the beginning of a bearish move, especially if the price also drops below the moving average. A falling wedge, on the other hand, is typically a bullish pattern, forming when the price makes lower highs and lower lows with the range narrowing. A breakout above the resistance line of a falling wedge, confirmed by a price move above the moving average, can signal a strong upward movement. Pennants are another chart pattern often used in combination with moving averages. Pennants form after a strong price movement and represent a period of consolidation before the trend continues in the same direction. These patterns look like small symmetrical triangles and can appear during both uptrends and downtrends. When a pennant forms and the price moves above a moving average, it can suggest that the trend will continue upward. Conversely, if a pennant forms in a downtrend and the price remains below the moving average, it can indicate that the trend will continue downward. Another important pattern is the cup and handle. This is a bullish continuation pattern that looks like a cup followed by a small consolidation period known as the handle. When the price breaks above the handle, it often signals a strong upward move. If this breakout occurs while the price is above a key moving average, it can provide additional confirmation that the uptrend will continue. Finally, rectangles are continuation patterns that form when the price moves sideways between support and resistance levels. The price essentially trades within a defined range, creating a rectangle shape on the chart. When the price breaks out of the rectangle, the direction of the breakout can determine the next move. If the price breaks above the rectangle while staying above a moving average, it can be a strong bullish signal. Conversely, if the price breaks below the rectangle and stays below a moving average, it can indicate a bearish continuation. By combining these various chart patterns with moving averages, you can get a much clearer sense of where the market is likely to move. Patterns like wedges, pennants, and rectangles provide valuable context that can be confirmed by observing the price's position relative to moving averages. Let us expand on these patterns in a way that anyone can understand. A wedge pattern looks a bit like a narrowing funnel. It happens when the price starts to move within two sloping lines that get closer together over time. There are two types of wedges, a rising wedge and a falling wedge. A rising wedge is when the price moves higher, but the lines get closer together. This can often mean that the upward trend is losing strength and the price might drop soon. A falling wedge, on the other hand, is when the price moves lower, but the lines are getting closer together. This can signal that the downtrend is weakening and the price might go up soon. Pennants are patterns that appear like small, compact triangles on a chart. They usually form after a strong price move in one direction. Imagine a flag flying on a flagpole with the pole representing a sharp price move and the flag itself being the pennant. When a pennant forms, it often means that the price is just taking a short break before continuing in the same direction. If the price was moving up before the pennant, it might keep going up afterward. If it was moving down, it could keep moving down. Rectangles are much simpler. They form when the price moves between two clear levels, like bouncing between two floors of a building. The price moves up and down between these levels for a while, creating a rectangular shape on the chart. When the price finally breaks out of the rectangle, either above or below, it often keeps moving in that direction for a while. Think of it like a spring that is being compressed between 2 points. Once it is released, it moves quickly. Cup and handle is another pattern that is easier to understand when you think of the name. Imagine a cup shape forming on a chart with a gentle dip followed by a rise. After that, a smaller dip forms, which looks like the handle of the cup. When the price breaks above the handle, it is often a sign that it will keep moving up. It is like building momentum. The price takes a break forming the cup, then gathers energy forming the handle, and finally continues upward. These patterns are not just shapes. They tell us a story about how buyers and sellers are behaving in the market. By combining these patterns with moving averages, you can understand whether the market might continue in the same direction or reverse. As you practice identifying these patterns and using them with moving averages, you will develop a better understanding of market trends and signals in a straightforward and practical way. There is also something called a crossover, and this is a very popular concept in trading. A crossover happens when one moving average crosses over another moving average. For example, if a 10-day moving average crosses above a 50-day moving average, this is called a bullish crossover. Traders see this as a signal that the market might start trending up, and they might take this as a chance to buy. On the other hand, if a 10-day moving average crosses below a 50-day moving average, it is often called a bearish crossover. This can mean the market may be heading down, and it might be time to sell. Using the moving average to identify trends is one of its most powerful uses. Let us say you see the price staying above a rising moving average. This is a pretty good indicator that the market is in an uptrend. Many traders will buy or hold their positions if the price stays above the moving average. It is a simple but effective way to understand the trend. If you see the price below a falling moving average, that usually means the market is in a downtrend. In this case, traders often sell or avoid buying. A lot of people find this helpful, especially when they are trying to decide whether it is worth staying in a trade. Sometimes the price might move right around the moving average without really going far above or below it. When this happens, it can be a sign that the market is not in a strong trend. If you see the price staying very close to the moving average, it might mean the trend is not strong, and it could be best to wait for a clearer signal. There is another trick traders use, and that is combining different moving averages. By looking at more than one moving average, you can get a better sense of what the market is doing. One common technique is to use a short-term moving average and a long-term moving average together. For instance, you might use a 10-day moving average and a 200-day moving average. When the 10-day crosses above the 200-day, this is called a golden cross. Many traders see the golden cross as a sign that the market is going into an uptrend, and they often use it as a signal to buy. Another powerful combination is using a combination of multiple moving averages of different time frames to create what is known as a moving average ribbon. A moving average ribbon consists of several moving averages plotted on the same chart, each with different periods. For example, you might plot 5, 10, 20, 50, 100, and 200-day moving averages together. When these moving averages are closely aligned and start to spread apart, it indicates that a strong trend is forming. The more moving averages that align and spread in the same direction, the stronger the trend is likely to be. Conversely, when the moving averages start to converge, it can signal a weakening trend or a potential reversal. The moving average ribbon provides a visual cue that makes it easier to identify when trends are strengthening or weakening. Another technique is the triple moving average crossover strategy. This involves using 3 different moving averages, typically a short-term, a medium-term, and a long-term moving average. For instance, you might use a 10-day, 50-day, and 200-day moving average. When the short-term moving average crosses above both the medium-term and long-term moving averages, it can be a strong buy signal. Conversely, when the short-term moving average crosses below both the medium-term and long-term moving averages, it can indicate a strong sell signal. This method adds an extra layer of confirmation, which can help reduce false signals compared to using just two moving averages. Finally, some traders use exponential moving averages instead of simple moving averages when combining different timeframes. Exponential moving averages give more weight to recent prices, making them more responsive to recent price changes. This can be useful when traders want to react quickly to new market conditions while still using a longer-term perspective for context. Combining a short-term exponential moving average with a longer-term simple moving average can help traders identify opportunities while still filtering out noise from short-term price fluctuations. On the other hand, when the short-term moving average crosses below the long-term moving average, this is called a death cross. It is not as scary as it sounds, but it is something to pay attention to. The death cross can mean the market is turning into a downtrend, and traders may sell or close their positions when they see this. The moving average can also act as support or resistance. In an uptrend, the moving average can serve as a support level. This means that if the price falls, it might bounce off the moving average and continue going up. Traders will often wait for the price to pull back to the moving average and then buy, expecting the trend to continue. In a downtrend, the moving average can act as resistance. If the price rises but does not go above the moving average, it can mean the market is still in a downtrend, and this can be a signal to sell. You can also combine the moving average with other tools to make it even more powerful. For example, you can use something called the relative strength index. This is another indicator that helps you see if the market is overbought or oversold. If the price crosses above the moving average and the relative strength index shows that the market is oversold, it can be a strong signal to buy. Another tool that works well with moving averages is the moving average convergence divergence. This might sound complicated, but it is basically a way to see the momentum of the market. If you see the moving average convergence divergence crossing in the same direction as a moving average crossover, it adds more strength to the signal. Do not forget about volume. If you see a crossover and it is supported by high volume, this makes the signal stronger. High volume means that a lot of people are trading, and this can confirm that the trend is real. If the volume is low, the trend might not be strong, and it could reverse soon. The moving average is an excellent tool, but it is important to avoid common mistakes. One mistake is to rely only on the moving average. Remember that the moving average looks at past prices and it does not predict the future on its own. It is a good idea to combine the moving average with other indicators for a better picture of what is happening in the market. Another key mistake to avoid is misinterpreting chart patterns that may form alongside the moving average. Chart patterns like head and shoulders, double tops and bottoms, triangles, wedges, pennants, and flags provide valuable insights, but they require proper understanding. For example, a head and shoulders pattern might indicate a trend reversal if formed after an uptrend, but traders need to confirm this signal with additional indicators like moving averages or volume. It is also essential to understand the context of the pattern. Double tops and bottoms, for instance, are more reliable when confirmed by a break below or above key support and resistance levels, ideally supported by a moving average trend. Triangles, whether ascending, descending, or symmetrical, often require confirmation of breakout direction by checking whether the price is also moving above or below a relevant moving average. Using multiple confirmations can help avoid making premature or inaccurate trading decisions. When interpreting wedges, it is crucial to pay attention to the slope of the moving average as well. A rising wedge during an uptrend combined with a flattening or declining moving average can provide additional confirmation of an upcoming bearish reversal. Similarly, a falling wedge in a downtrend, along with a rising moving average, can strengthen the case for an upcoming bullish reversal. Flags and pennants are continuation patterns that need proper volume analysis for confirmation. When a flag forms and the price remains above a key moving average, traders should look for increasing volume upon breakout to confirm that the continuation is supported by market activity. Low volume may indicate a false breakout or a weakening trend. By being thorough in combining chart patterns with moving averages, traders can significantly enhance their accuracy in reading market movements. This approach not only reduces the risk of false signals, but also provides a comprehensive understanding of what the market is trying to communicate. Another mistake is overreacting to small crossovers. Not every crossover means a big change is coming. It is important to be patient and wait for strong signals rather than reacting to every small move. This is where practice can help a lot. A third mistake is not paying attention to what is going on in the broader market. If the market is very volatile, a crossover might not be as reliable. Make sure to look at the bigger picture before you make decisions based on the moving average. If you want to get better at using the moving average, the best thing to do is practice. Try using a demo account to put moving averages on a chart. This way, you can experiment with different time frames and crossovers without risking real money. You can practice finding trends, crossovers, and using other indicators to confirm what you see. Keep track of your trades and write down what works and what does not. This helps you learn and improve over time. You might notice that certain setups work better than others, and by keeping track, you can focus on those that work best for you. Also, do not be afraid to try out different combinations of moving averages. Use short-term and long-term together and see what happens. The more you practice, the more comfortable you will get, and soon you will start to see the value of this tool. To wrap things up, the simple moving average is a helpful tool that can give you a better view of the market. It smooths out price data, helps you find trends, and can even act as support or resistance. Whether you are using it for short-term trades or long-term investments, the moving average is a great tool to add to your trading strategy. In addition to moving averages, expanding your knowledge of chart patterns can significantly enhance your market analysis. Patterns like head and shoulders, double tops and bottoms, triangles, wedges, flags, pennants, rectangles, and cup and handle can all play an important role in predicting market movements. For instance, understanding how the head and shoulders pattern often signals a trend reversal, or recognizing the difference between a bullish and bearish wedge can help you make more precise trading decisions. Do not forget to pay attention to volume when assessing these patterns. Volume can be a strong confirming factor for breakouts or reversals that occur within chart patterns, and it can make a big difference in determining whether a trend is likely to continue or reverse. Combining moving averages with well-recognized chart patterns and volume indicators allows traders to gain a comprehensive view of market conditions, reducing the uncertainty that comes with relying on a single indicator. Remember that while these tools can provide valuable insights, Successful trading takes time and practice. Learn to recognize patterns, combine them with other indicators, and test your strategies in a risk-free environment before making real trades. The more you practice, the better you will become at understanding and anticipating market movements. Start by adding moving averages to your charts, practice with different time frames, and pay attention to crossovers. Combine it with other indicators to confirm your trades, and always keep an eye on volume. The more you practice, the better you will get, and soon enough, you will be making more informed trading decisions. If you have questions or thoughts on this, do not hesitate to reach out and share them. Trading is a journey, and every bit of insight helps us all grow. Keep practicing, keep learning, and happy trading.